welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
A lot of noise, a lot of people with different expectations coming in, but if you look at the signal away from the noise, you realize that this is unprecedented capabilities that Apple is going to introduce, and it's going to integrate AI into everyday life.
The Fed, I think, is going to stay put tomorrow. It's going to be a pretty boring meeting, actually. I think it'll be interesting to see the economic projections that come out and how they change, if at all, from the March projections. But we really, as we get into 2025, we still have conviction the Fed's going to continue to see disinflation towards their target.
So we're able to invest in the business, we're able to maintain a strong balance sheet, and we're able to return cash to shareholders. So we've completed that prior buyback authorization that we had done, and pleased to announce that the board has just authorized another $6 billion in share repurchases that will commence beginning in the second half of 2024.
1 hour to go until the market closed. So let's take a look at the major averages here. We have a mixed picture here today. Right now, the Dow is lower by almost 120 points. That's about 1/3 of 1%. However, the S&P 500 and the Nasdaq are higher for now. We had seen the S&P lower for much of the session before peaking into the green here. Any gain for either of these indices or both of these indices will mean another record close. Both of them closed at a record yesterday, so any gain today will mean another record close. So that's something to keep an eye on here today. I'm also watching the bond market. We are seeing yields fall, prices rise, and that's after we had an auction of 10-year notes worth $39 billion that drew higher than expected demand. In fact, the highest demand going back to February of 2022. So that higher prices is pushing down yields here today, which is also sort of percolating through the market. And of course, important as we are keeping an eye on tomorrow morning's consumer price index report, consumer inflation, of course, and the results of the Federal Reserve's meeting. Let's also take a look at what's going on with some of the other sectors that we are watching today. Let me just get you to that. So as we are watching sectors, when I talk about the percolation through the market, that's what I mean here. For example, we've got all kinds of interesting things happening here today that I'm going to try and fix. We were looking at the sectors. There are the no, we're still looking at market cap in the sectors, and I don't know how to fix that. So I'm just going to send it back to Josh.
We'll take it from here, Julie. It's the magic of live television. That's what we do. We are an hour away from the close. Stocks clawing back from sharp declines earlier in the session as investors are waiting on that key CPI print tomorrow. It's going to be followed by the latest decision, of course, from the Federal Reserve on interest rates. And joining us now for what to expect and how investors can best be positioned ahead of the news, let's welcome in Omar Aguilar, Schwab Asset Management CEO and CIO. Omar, great to see you on set.
Oh, yes, glad to be here. Always be happy to be in New York.
Omar, so listen, let's start there. The Fed kicking off the big meeting. What do you expect to hear from Jay Powell, Omar? What are you going to be listening for?
Well, it is a clear, decision already that they're not going to make any changes to monetary policy. And I think investors will basically be looking at the combination of the CPI report in the morning to also with just the language that the Fed will use into their description of their decision. And in many cases, the expectations, no matter what, is that the Fed continues to see that there's this disinflation trend that seems to be giving them enough flexibility. And what that means is, they still have the option to actually have a revised dot plots that will give them 1 or 2 rate cuts before the end of this year.
Every day we talk about this. And we talk about whether the Fed is going to cut once or twice or none, and when they're going to cut, what's the timing going to be. How important is all of that when we're trying to figure out the effect on equities specifically?
Well, a couple things. One is, it is kind of an interesting that market expectations have been completely wrong for a while. And what that means is that they, at the beginning of this year, the market had priced in 6 rate cuts. And not until recent, there was enough discussion about the potential for even a rate hike. which is kind of like confusing in many cases. So as you go through this, the strength of the US economy, when you actually see the strength of the consumer, the strength of the labor market, seem to given a lot of confirmation of what the Fed decision has been, which is being very data dependent and being consistent with their views that they will make the decision and they will make the move when the economy and the markets are ready for it.
What's, Omar, right now your base case for when you think the Fed does cut? Are you September, December? Where are you?
You know, September seems to be the most likely scenario for many reasons. One is we finally starting to see the effects of the lag effects of the federal decisions of rate hikes into the labor market. We're finally starting to see that crack when now we have unemployment at around 4%. And what that means is that we're starting to see people that are not quitting their jobs as quickly. That's based on the JOLTS report. We're starting to see that the fact that actually baby boomers are retiring and they're not being replaced as fast as they used to be in the past. And with those dynamics going forward, the potential for normalization of wage growth, not necessarily reduction in wage growth, but normalization of wage growth will provide the Fed with enough ammunition to actually make, the first cut. And the second reason for that is that the Fed is looking very closely at the real rates. As inflation goes down and they don't cut any rates, the effect of real rates into the economy could have a more significant impact going into next year.
Josh, you're going to love this question.
Yeah, hit me.
Is the meeting tomorrow going to be boring? Like what, when we don't necessarily expect them to do anything in a meeting, yes, we're going to get the dot plot. Like, what are you trying to pull out from Jay Powell? What do you want to know tomorrow?
Yeah, it sounds like boring is the word of the day.
But it's not boring. I want us to make the argument it's not boring, hopefully.
Well, I actually think that the meeting is going to be quite boring. I do think that the market reaction may not be as boring.
Okay.
And you can actually think that the combination of the CPI in the morning could make the market move, and the Fed decision could actually make it go the other way.
Well, and it's quite rare, right, that you get them on the same day and that you could actually have Powell reacting to, usually he might know some of the numbers, but he can't tell us and react.
Right.
So this is unusual.
This is a very unique situation where they line up to be on the same day. And I would imagine that they were probably prepared to say, no matter what the CPI report, we're going to already have these, ready to go. But that being said, what has happened so far is that market reaction and market expectations and Fed decisions, they have had a gap. They haven't actually been aligned, for quite some time. So I think the expectation is that we're going to see some volatility throughout the day. That's not going to be boring. The meeting might be boring.
All right. Omar, for the viewers who are listening right now, they're investors, what are you screening for in the market right now? What looks attractive?
Well, a few things. One is, we're starting to see these divergence in monetary policy around the world. And, for the longest time, this is the first time where I said, actually looking at international markets seems to be the most attractive on both fixed income and equities.
Which markets specifically, Omar?
Developed markets. And you actually see the UK and Europe, when you actually look at their multiples, the average stock is actually right at the long-term average. In other words, they're fairly priced. When you compare that to the US market, we're basically already way ahead of our averages overall. So relative valuation favors, international markets. Secondly, when you actually think that the ECB and the UK and the Bank of England are already in the cutting cycle, that actually provides a good tailwind for the potential rise in their equity markets. Again, the biggest question mark is the dollar, because again, with the Fed on hold, or at least waiting for the first cut, we're starting to see that effect. But it's interesting to actually look at those opportunities on the equity side. In the US, we continue to say that being in the high quality part has paid off for the last year.
What does high quality mean to you, Omar?
Free cash flow yield, companies that generate enough free cash flows, companies with the stability of earnings, and companies that continue to have good dividend potential growth. They don't necessarily have high dividend pays, but they can actually generate consistent dividends. And if you actually look at that cohort, that has outperformed the market by roughly around 10% over the course of the last year. So staying high quality right now with all the volatility, with everything that hosts macro, with companies in the process of generating free cash flow, So it is a good, way to, invest for the next, 12 months.
Omar, I want to ask about another way to sort of slice and dice it, and that is growth versus value, which is something we haven't talked as much about recently. Bank of America, though, was out with a note where they pointed out the immense allocation that we have seen to growth as of late. We have a chart of it there where they say in ETFs, there's a $75 billion gap between growth and value. People own a lot more growth right now. They actually think value, and we've heard this for a while, but they think value is going to start to come back again. Do you think that that's in the cards?
Yeah, well, I would actually tend to take a slightly different take on it, because the definition of growth and value, it's something that index providers have created based on what they think. And in many cases tends to be related to price to earnings or price to book. That, in our view, is not necessarily the way to think about investing for this. So the way we'll take a look at it is that we still think that high quality growth, the capex cycle is right into probably the second or third inning. And if you think about all the money that is going into AI, that has translated into potential what is called growth to being that way. And for us, at least for now, there shouldn't be any catalyst that will potentially burst that, at least not in the next 12 months. As long as they continue to be stable, generate free cash flow, and have a solid balance sheet, those sort of traditional or what is called growth companies will probably continue to do well. Now on the other side, cyclicals, which now are more like value type, they're also attractive because of the expectations of lower rates. So what that means, materials, financials, real estate, they could potentially have that early cycle benefit. So which we will recommend that we will take, a barbell approach where you don't have to take your chips all from growth, but then, combine it with early cycle areas, including, which is a little more controversial, is small caps. Which again, a lot of people are not comfortable saying.
That's been a tough call this year.
It's been a very tough call, and people say, it's better to be early than being wrong. But it's that thing of the waiting game where you actually get into small caps.
I guess it depends when you need those returns. Omar, thank you so much, and it's great to see you in person. Appreciate it.
Thank you so much.
We're just getting started here on Market Domination. Coming up, Apple soaring to new highs one day after unveiling its Apple Intelligence platform. Despite the rally, we have one analyst next who says yesterday's event was disappointing. We'll explain why ahead. Plus, shares of General Motors riding higher after authorizing a new $6 billion share buyback program. But it wasn't all good news. We'll hear from the company's CFO on the other side.
And software giant Oracle set to report earnings after the bell today. We'll bring you the results and instant analysis in the 4 p.m. hour. Stick around, much more market domination still to come.
General Motors approving a new $6 billion stock buyback, the company noting its focus on the profitability of its ICE business. Yahoo Finance's Prosper Money and joining us here to discuss ICE being the legacy business.
Yeah.
What does ICE stand for again?
Internal combustion engine.
Thank you. Oh yeah, that makes sense.
ICE, yeah. So yeah, the gas power business still doing well. They haven't fully ramped up their hybrid business yet. They only have one hybrid for sale, but EVs also, they were slow in the uptake, but now actually doing quite well. We'll get into that in a little bit. But first, that big $6 billion buyback program they announced today comes in addition to the $10 billion share repurchase plan they had last year. So really amping up their capital return plans to shareholders. I spoke to GM CFO Paul Jacobson about that and what sort of was behind the scenes there for why they wanted to kind of increase those capital return policies.
We're continuing to lean into our capital allocation policy, and as the business has continued to perform and we've seen stable pricing, we've seen disciplined incentives from our team, and we've seen a vehicle portfolio that is customers just love. And all that spells a lot of success. So we're able to invest in the business, we're able to maintain a strong balance sheet, and we're able to return cash to shareholders.
So I mentioned that EV business earlier. They did get a slight update there on the fact they want to build around 200 to 250,000 EVs by the end of the year. A little bit of a lower upper bound amount than 300,000 they had originally projected. So they're still ramping up EVs, just not at a high pace as they thought they would. He did tell me they sold 9,500 EVs last month, which is a record for them, and new cars coming online. So they're not shying away from it. They're just sort of easing into it, and they're going to keep growing it, and they're not going to pull away just quite yet.
Interesting. All right, thanks, Pras. Appreciate it. Well, NextEra Energy shares dropping after the company reported a lackluster 2027 forecast. The company had an investor update today and said for 2027, which obviously is down the road a bit, adjusted earnings per share will be $3.85 to $4.32. The estimate is $4.33. So, and I believe fiscal 2027 is actually next year, if I'm not mistaken, the way that their fiscal calendar works. The shares are up about 19% year to date. They've been part of this big utility rally that we've seen, Josh. And so this taking a little bit of air out of that.
Yeah, I just read some recent reports on other news they had made recently, Julie, on Friday. Headlines dropped, development agreement to accelerate solar generation and energy storage projects with, I guess, Entergy. The stock is up about 20% this year, which is a nice run. Over the past 12 months, it's kind of actually in the red, and down today, obviously.
Right. Well, it's been part of that whole lift that we have seen for utility stocks linked to the demand for electricity for data centers.
Who told us Iron Man? Who was that?
That
Utilities are the Iron Man of the stock
who
market.
said Iron Man?
Was it from,
it was Cantro.
That's right.
Michael Kantrowitz from Piper said that.
Offense, defense.
Offense, defense, because they do tend to be defensive, but could maybe grow as a result of this. NextEra in particular is the owner of Florida Power and Light, which is one of the nation's largest power companies, obviously based in Florida. But it also is the owner of NextEra Energy Capital Holdings, which is the largest generator of electricity from wind and sun in the United States. So big renewable energy provider as well. And that for some of these companies who have made promises, some of these big tech companies who've made these sort of zero carbon promises or net zero promises, that is an important input for those kinds of companies.
In the right place.
Yeah, exactly.
Moving on, just got shares of Affirm as well. They got a lift after Apple announcing a partnership with the Buy Now, Pay Later platform. So that was the news today. Said its payment products should expect to be available to Apple Pay users in the U.S. later this year. So I guess it sounds like if you're checking out online or an app with Apple Pay, then you can apply to pay over time with Mac Levchin's company. I checked in with Dan Dolev over at Mizuho. He told his clients he saw this as a big positive. Said the stock traded down several times in the past. He says when Apple kind of announced it was moving into Max's market. Says Affirm's strong brand, though, sophisticated underwriting technology, have a moat that Apple likely could not replicate on its own. Really rates his buy in the name.
Which is interesting. You don't hear that too often about various areas that it gets into. But indeed, this is why the stock is up today, because it's sort of a relief here. It's not, even though Apple, it seems to me, is still competing with them because they didn't get rid of their own buy now, pay later. It's just that this is an option on the Apple platform. The stock is down, as we just saw, quite a bit year to date, about 33%, in part because these concerns, in part because of concern about regulation for buy now, pay later, et cetera. But so you also seeing some relief in the stock today, after it has fallen.
Yeah,
so
apparently
much.
the company does not think this is going to have some big impact on revenue or GMV, at least in
Not
fiscal
yet.
25. To your point, the stock's popping today, although you're right. I mean, pull back the chart. It has been a rough start to the year for that company.
Yeah, but guess what? We're going to hear more about this story because you should tune into Yahoo Finance's podcast opening bid on Friday at 8 a.m. Eastern. Our executive editor, Brian Sazi, will be speaking to CEO Max Levchin of Affirm to get more color on all of this. Well, we talked about Apple here. Those shares are rising to intraday highs as investors are digesting the tech giant's announcement of its AI platform. This comes as a reversal to declines in the stock after Apple's keynote presentation yesterday. For more on what can drive gains for Apple, let's get to Laura Martin, Needham Senior Media and Internet Analyst. Laura, it's great to see you as always. You were not terribly impressed by what we heard yesterday. And I did think it was interesting that there was sort of this meh stock reaction, and now the shares are rallying again today. What do you make of it?
So, I mean, I think that they are, they just talked for 65 minutes about new colors and emojis and capabilities. And I felt like a Snap CEO talking, like we're going to target 22-year-olds. When their average owner of smartphones in their 40s and in the top, 10% of incomes globally. But so I thought that was weird. And then they did generative AI sort of in the last 20 minutes. And I think Wall Street only cares about generative AI. Why? Because Apple, their revenue was down last year 3%, and this year we're projecting 1% revenue growth, which is really uninteresting as a stock unless they're going to use generative AI to drive an iPhone replacement cycle. And iPhones are over 50% of their total revenue. So, and I just didn't hear that yesterday. So that means I didn't change my estimate, or the consensus estimate also didn't change. They're going to grow revenue at 1%. Let's go to sleep, guys, and let's put our money somewhere else. So you saw selling throughout the keynote speech because we just don't, nobody's changing their estimates today based on Gen AI, and you have to wait a year. They only do these updates once a year, and they only do sort of product upgrades once a year. So now we didn't like what they said yesterday. We're going to wait a year to figure out whether we like what they say next year about Gen AI.
But Laura, correct me if I'm wrong, you do have a buy on this name, right?
Yep.
So how come? You weren't excited by what Tim Cook had to say on stage yesterday, but you must be excited by something, Laura. What are the catalysts ahead?
So let's see. Google, which is Alphabet, Amazon, and Microsoft are all spending $100 billion building large language models for Gen AI, because they're going to take a 10% tithe on every dollar earned in their clouds on Gen AI. That's interesting. Strategically, long-term, really bad for the P&L. Your returns on capital are falling in those enterprises this year and next year. And then they're going to dominate the world. Opposite with Apple. Apple's not raising their CapEx guidance at all, not a dollar, but they just announced a $100 billion share repurchase, telling you they don't think they have anything better to do with their money than return it to us. So while I just told you that our sales are going to go up 1%, their EPS is going to go up 8% because they're buying in shares, which is putting a floor under the shares. So as a shareholder, you want to be in Apple this year while they're returning cash to you. But in 4 years, you don't want to be anywhere near this stock because it's going to be in a strategic box. Whereas these other companies that have already spent the money 4 years from now are going to be sort of riding the big wave of generative AI innovation.
Laura, what I'm really curious about, though, as I heard Apple yesterday, even if you weren't that excited by what they were saying, in terms of generative AI and the role it plays in our everyday lives, it's virtually zero, right? Yes, I Google something and it summarizes something with AI at the top of the page. Big deal. I got my face in this thing all day long, and now it's going to have AI integrated. So isn't this really going to be most consumers' first real opportunity to be convinced that they need AI functionality?
No, I don't think so. I mean, about half of my companies are using generative AI today. I was on a call, and they're going to do panels. They're going to make lookalike, I'm going to call it people or proxies of people that looks like a Bulls fan. And then they're going to run advertising by that generative AI panel to figure out before they actually run a test market in the real world, which is $1 million, to figure out which ad that's going to lower the cost of advertising. I have companies not using an ad agency anymore because they're having generative AI create the ad, put the music to the ad, and create different slogans and put them different places with A/B testing themselves. Generative AI, as you know, writes text, it writes headlines, it personalizes things, all in real time at a tenth of the cost of the old world. So no, I think generative AI is here to stay. And a lot of companies are making a point of how they're using generative AI today, not tomorrow, not when they launch their next product in September or December. Like Apple said, they are using generative AI today. And a lot of my companies are saying they're going to cut costs 20 to 30% in areas where they're using generative AI to replace people, like in services or chatbots, which we've seen a lot of so far.
Laura, it is always good to have you on the show. Thanks so much for making time.
My pleasure.
Coming up, what's next for Eli Lilly after FDA advisors backed his Alzheimer's drug? We're going to be speaking with an analyst on the other side. Stick around, more market domination still to come.
Let's check on oil prices right now. We have seen them edging higher, making up for some of the declines from last week and rising 3% yesterday, actually. This all coming after OPEC stuck to its demand forecast. Joining us now, Bob Iaccino, co-founder and chief market strategist at Path Trading Partners and co-portfolio manager, the stock think tank. Thanks so much for being here, Bob. So as we look at oil prices and as we saw OPEC sticking to its guns here, sort of contextualize this for us. What's the significance of them not changing the forecast?
Well, first of all, Prince Abdulaziz said a couple of days ago when the market started to head a little bit higher off of this and then turn back lower that give it a few days, the market will get what they were trying to say. And it seems to me what they were trying to say was, yeah, we're willing to get rid of the voluntary production cuts, in part because those production cuts are voluntary anyway. And a lot of these countries, specifically Iraq and some of the African producing nations, weren't really sticking to the voluntary section of the production cuts. But they didn't say they would do it. You know, a lot of oil analysts were saying this is the first sort of indication we've seen of more production, and prices went lower. But what we're seeing on the other side of it is the demand side might be a little shaky in terms of the sort of level demand that we've had lately. The summer driving season seems to be getting off to a pretty good start. You're seeing that in the consumer data as well as a little bit of the travel data. And also we have jet fuel shortages starting in Japan. And if they were to get more jet fuel made, that would be taking crude oil away from other distillates, which means they need more crude oil, at least going into Japan. Not a giant part of sort of supply absorption, but it would matter. They'd either have to export more or disappoint the market, which would increase the price of travel by air and increase the usage of people's cars for travel during this summer driving season. There's a lot of moving parts here, but I think probably the most important one, Julie, to be honest, is the US rig counts, which have been going down basically since February of 2022. And this past Friday, we got the lowest number since January of 2022. That's not really a good sign for supply.
So, Bob, bottom line for you then, I'm looking at oil here, it's trading just under 78. Where do you think we are, Bob, in 3 months from now, 6 months from now?
Well, that's a tough question, Josh, and I'll tell you why. We've been in a downward sloping channel that you can see on the chart you just put up since about April. Let's call it mid-April. And we haven't broken out in either direction. And the thing is, when you stay inside these channels, even if you continue to respect the upper and lower bounds of the channel, price heads lower. The market tried to break out a little bit a few days ago and actually did end up closing above the upper side of that channel, but then broke back into it, reached down to the bottom, and now we're back up toward the top of it. Even if we break out now, we're about $3 lower than the breakout from a few days ago, and there's still some significant problems getting through to the upside. So if you ask me 6 months from now, we're probably a little bit higher in crude oil. Remember, we still, in theory, need to refill the SPR. So that puts a little bit of a floor in it. But it's tough to say because it's very economically dependent in terms of the data. Does the data get better? Does it continue to get stronger in the US and have that leak all over the globe? Or does it just kind of stay stagnant and the Fed doesn't have to do anything? That would basically mean slightly lower prices.
Well, I want to ask you specifically about the read-through to gasoline prices as well, because AAA, put the national average at $3.44 as of Monday, which is down the biggest actually week-over-week drop that we've seen thus far this year. Does that last for the summer, that we continue to see some relief on gasoline prices?
Probably not, because obviously with the crude oil, I don't want to call it a glut. We're oversupplied. You could tell that in the price. All right, that's something that's very good about people who are actively investing in crude oil, is it is a pure supply and demand market. It really is. You don't have to worry about CEO scandals or gap earnings or any of that. It's how much oil's out there and how much oil are people buying? What's the demand like? And right now, the supply has been exceeding the demand despite the OPEC cuts. And those OPEC cuts are almost 2 years old now, and they're remaining in place. So I would say that it probably doesn't last through the summer because there's a lot of moving parts, like I mentioned. Airline travel may spike up a little bit, and you could get, of course, geopolitical surprises. So if you ask me by the end of summer, I'd say we're probably a little bit higher at the pump than we are right now.
Bob, always appreciate you taking the time to chat. Thank you so much.
Good to see you.
All right, let's get to some calls of the day now. JP Morgan downgrading Cleveland Cliffs from overweight to neutral. It also lowered the price target from 23 to 17. Main reasons for the downgrade, they say, lower steel prices and higher spending. You see the stock down about 3.5% in today's trade. So that was really it, Julie. They were talking to their clients about, listen, rising CapEx needs they called out. They say auto inventories are now replenished, no near-term growth projects. They said the balance sheet does look cleaned up. They like this greater focus on, I guess, shareholder returns, but they think most investors, in their opinion, would prefer cash accumulation for maybe some potential M&A rather than, they say, debt-funded buybacks we're seeing.
Yeah, I mean, they don't seem to be, I mean, they're just neutral, so they don't seem to be too negative. A lot of the calls does seem to be, besides what you're talking about how they're using their cash, seems to be more macro effects. Among the pricing pressures that you talked about is also that EV demand is just not fantastic. And so that's something that has been a headwind, or at least a lack of a tailwind for demand and a lack of a support for pricing. So that's pretty much what's going on there. $17 is the price target. They're now putting on Cleveland Cliffs.
Sentiment, I mean, just fairly negative on this one. Stocks now got hits down more than 25% this year. And even then, I mean, most analysts still on the sidelines.
Yeah, let's also talk about a call on Walmart. HSBC is raising its price target on Walmart from $70 to $81. It's also maintaining its buy rating. The stock not doing a heck of a lot today. It's down about 0.5%. But basically, this note is in reaction to the company's shareholder meeting, which it held last week. And among other things, basically, the analyst here is talking about a sort of a more nimble Walmart, that it is expressing willingness to exit businesses that aren't working, including that health clinic business. It said it's going to close them all after not working for more than 5 years. So that's one of the things that they were pointing to as a potential catalyst.
Yeah, I mean, there was a lot, it was interesting. I mean, just in reaction to that meeting, a lot of analysts on the street were sounding a lot of positive tones. JP Morgan, for example, upgrade to overweight off that. Walmart is winning over Wall Street, so let's continue that chat. But the shopping giant will need results from its e-commerce business to maintain its position. Brooke DePalma, who recently went to Walmart's annual meeting, is here to break down how it plans to turn its e-commerce business profitable.
Yeah, Walmart executives did note to investors that it thinks that it could turn the e-commerce business profitable in the next 1 to 2 years. And there's 3 ways, some of the many ways that they plan to do this, but 3 key ways that we're identifying here is Walmart needs to play catch up when it comes to the AI game. Amazon has been so ahead of that. So earlier this year, Walmart did announce plans to use Gen AI to personalize search. So for example, you type in a birthday party, Walmart.com will then show you candles, decorations, and cards. And Walmart executives really saying here that this will allow them to get customers what they want when they want it. And one executive telling Yahoo Finance that he believes that Walmart has the best data for AI models because of both in-store and online business. Now that brings us to the next point. It plans to leverage its physical store locations. CEO Doug McMillon did tell Yahoo Finance that Omni actually is the preferred offer for customers. They like going in stores, but they also like going online. And e-commerce has been a booming business for Walmart, but it hasn't necessarily come at the expense of in-store shopping. We've seen growth there as well. Walmart executives touting the fact that around 90% of Americans live within 10 miles of a Walmart location. That's more than Target and more than Costco. It also said that it can offer and charge customers for express 1-hour or 3-hour delivery using that store presence. The last opportunity here, guys, is a new opportunity that it's been growing lately. That's their Walmart Connect business. It's their ad business. And what we know is that last quarter, Walmart Connect saw sales jump 26%. So now Walmart is really implementing those sponsored video ads at the top of those results online. They're also using in-store advertisements and off-site ads on TikTok as well as Disney+.
I have to say that point number 2 there about leveraging the physical stores, I've been hearing that song for a long time from Walmart.
It's been a dance that they've been playing for a while.
Like, we're going to leverage the physical stores. They haven't done it so far, so
I mean,
maybe.
pickup delivery is one way that's really driving e-commerce growth. And when I asked Doug McMillon, the CEO there, if they plan to continue to grow stores, he actually noted that they plan to increase store locations where people have moved to. So they're going to reassess their real estate strategy and take a look there. They certainly want to be near every single American.
But still, are they going to catch up with Amazon?
Not quite yet. Yeah, they're still pretty far from where Amazon is. If you take a look, last year, Amazon brought in $47 billion in ad revenue. Walmart, only $3.4 billion. So a long ways away, but experts telling me that Walmart needs to work on awareness first. Not many people know that they have this quick, fast online delivery service. Not many people know about the Walmart Plus subscription. So really marketing, advertising that could be a key game changer for Walmart. But they are ahead of where maybe Target and Costco are when it comes to their e-commerce growth.
Yeah, Costco has not emphasized that for sure.
Not at all, really.
Thanks a lot, Brooke. Appreciate it. Well, Eli Lilly one step closer to getting its new Alzheimer's treatment approved by the Food and Drug Administration. Joining us now, Evan Siegerman, BMO Capital Markets Managing Director of Biopharma Equity Research. Thanks for being here.
Thanks for having me.
So the company getting a big boost with the FDA panel saying, okay, we're not going to do a black box, and this seems to be a good alternative. Talk to us about how it's going to fit into the marketplace.
For sure. So right now, the only approved anti-A beta antibody is Biogen Eisai's Leqembi. The sales haven't been great. It's been kind of an anemic launch. So investors have been hoping that the addition of another product, Lilly's donanemab, could kind of help lift the entire market, because having two products and basically three companies marketing the class should accelerate uptake. So that should be helpful. I expect that we could see approval near term. The AdCom was pretty successful. So hopefully Lilly will be off to the races soon.
And Evan, I'm just curious. I mean, obviously, you read, I'm sure, a lot of these results and results like this. I mean, how big a breakthrough was this?
So these drugs are incremental, right? They slow the cognition and function declines that we see when it comes to Alzheimer's disease. You get about 6 months of kind of a benefit, which frankly, if your parent had it, that would be a really good thing. I think the issue is kind of getting these drugs to the patients. It's infusions that are, twice a month, for example.
So it's delivered at the hospital.
It's delivered in an infusion clinic. So there's a lot of infrastructure there. But hey, it's something that actually affects the disease. So I think that's what's big here.
Oh, is the sort of difficulty or, the friction, if you will, of getting these treatments, is that one of the reasons that Biogen Eisai hasn't had more uptake?
There's a lot of reasons. I think first of all, getting the diagnosis is challenging. Before these drugs were available, physicians had no incentive to diagnose them with biocognitive impairment caused by Alzheimer's disease. They would just kind of worry them. So now they have to change that paradigm, get the diagnosis, get the PET scans, and then get patients into the infusion chairs.
And they also have to make sure that they even have the amyloids.
They have to make sure they're amyloid positive.
That they're even eligible
exactly.
to take these particular kinds of
drugs. And then
drugs.
MRIs to make sure they're not getting brain swelling, which was the discussion during the AdCom. So it's a lot of infrastructure to get these patients the drug.
When you try to look at the market, these treatments for Alzheimer's, and you try to model it, like how big is it now? How big do you think it could be?
Right now, it's like barely anything in Biogen's P&L. I think over time between these two products, it could be 10, 15, 20 billion dollars, but that's going to take a lot of time to get there.
When you say a lot of time, what would you?
I mean, like 5+ years, just given how slow the Biogen Eisai launch has been. Hopefully now that Biogen's putting their reps in the field, that should help. And with Lilly's reps in the field, that should help even further.
I'm really curious because we haven't talked about this in a while because all of discussion around pharma has just been swallowed up by the GLP-1 discussion. And I'm wondering, resourcing, what does that look like? What does R&D funding look like in the industry now? Is a lot of it going towards that shiny new object, or are we still seeing funding for Alzheimer's and cancer and all of these other important things to treat?
So it's really interesting because we just had the big cancer meeting in Chicago, and Lilly had an investor event that was focused solely on cancer, and they have a lot going on. So they are working in things beside Mounjaro and Zepbound, which is important. There is a lot of focus in obesity, but biopharma is definitely not shying away from oncology, inflammation, neuroscience. We saw 2 takeouts recently, Bristol with Karuna, AbbVie with Cerevel in the psychiatric space. So there is opportunity elsewhere outside of metabolic disease.
And then final one, you just look at the stock, and it's been just a monster. It's already up, 50% this year. You haven't outperformed though. So what are the next catalysts, Evan? For viewers listening, what do they have marked on their calendar?
Why do we keep liking this stock? Well, first of all, I look forward to second quarter earnings in early August, where we'll get updates on their on the launch of Zepbound, especially when it comes to supply, everyone's favorite topic, supply of GLP-1s. Beyond that, hopefully we'll get an update to their label to include the OSA data. Remember, they had sleep apnea. And then further on, we're looking for updates from their oral product or for Glipron. That's also been in focus recently. So they have more in the metabolic space and maybe an approval of donanemab outside of, Zepbound and Mounjaro.
Right, yes, there's other stuff going on.
There's other stuff going on. They'd be very happy that I'm reminding folks about that.
Yeah, Evan, thanks so much for coming in to talk to us about this. Appreciate it.
Thank you.
Thanks. Coming up, we're taking a deep dive into the evolving world of digital advertising in our Investor Playbook. A dramatic new development in the Paramount saga. Sherry Redstone's National Amusements reportedly deciding to stop discussions with Skydance. Yahoo Finance's Alexander Canales always is on it. What the?
Julie, did I not sit over there and we knocked on wood about this deal? But yes, this is very surprising. Ending those conversations with Skydance, according to the Wall Street Journal, Redstone will now like to pursue a sale of just National Amusements. National Amusements is the holding company that controls Paramount. Shari Redstone is head of that. That's the voting share, that's the power, and that's what she wants to sell. Prior, she wanted to potentially sell National Amusements, then whoever bought that would merge with Paramount into another company, but she wants to keep it separate. Now, when it comes to that potential sale of National Amusements, we've seen several names emerge. Stephen Paul, friend of Shari Redstone, also a producer. He's been a rumor name. He's reportedly offering her more money, funded by the founder of Patron Tequila. There's also been interest from media executive Edgar Bronfman Jr.
So many personalities.
So many personalities, and he's backed by private equity firm Bain Capital. But take a look at shares right now. They are down about 10%.
Well, because she keeps getting these offers. She keeps finding reasons not to take them. Pretty soon she's going to run out of offers if she keeps... I don't know. I mean, isn't that just...
And there have been analysts out there, Rich Greenfield being one of them, that he predicted from Lightshed Partners, he predicted that there will be no sale by the end of this year, that they're just going to be in wait and see mode. It's interesting with the Skydance deal because this is a deal that Shari Redstone initially wanted. She received some pushback from investors. Skydance went, they sweetened their offer multiple times. It seemed like we were in a good space. We had a positive share reaction on the heels of those talks developing. And now we have the talks ending. And you know, I thought something might be going on because when you hear no news for some time, she had the deal in her hand for about a week, didn't indicate anything. And you know, those employees were getting a little bit antsy here. So now the question is, okay, is she going to actually pursue a sale of National Amusements? Or at this point, is she just going to ride it out and see what happens?
You also wonder where the lawsuits fly. I mean, that was a lot of money being offered, $8 billion.
I know, a lot of money being offered, a high buyout if you were an investor of Paramount. And yeah, you wonder at what point, if you are a shareholder, do you get out of this name? Because you just don't know what's going to happen.
Well, there are some people getting out today.
Exactly, a lot of people getting out right now. We'll see where shares close.
We will. Allie, thanks for keeping on top of it for us. Whew. Well, Cannes Lions kicks off next week, marking one of the largest annual gatherings in the world of ads. The event coming amid a major ongoing shift in the world of advertising as linear TV declines. Streaming platforms are absorbing the revenue. We're looking at how to navigate the shifting landscape with the Yahoo Finance Playbook. And we're joined by Yigal Arounian, an analyst at Citi, who's going to that conference, by the way. Good to see you, Yigal. So glad to catch up with you before you head to the French Riviera for that conference. I'm just curious, what do you think is going to be sort of the main topic there? Because we're at this really interesting juncture here where consumer spending seems to be showing some cracks, you know, but I'm sure that there's a lot of competition for those ad dollars.
Hey, Julie, thanks for having me. Yeah, I think, look, this is the preeminent conference within the advertising and digital advertising world for the whole year. We're going to see likely a lot of news coming out of the conference. Last year, coming out of the conference, we kind of felt like the environment for advertising was getting stronger. I think over the course of the last year, the environment has gotten even stronger and stronger through to 1Q results, where really across the board, from top to bottom, across digital advertising, we've seen probably one of the strongest quarters we've seen in a number of years. From digital advertising. So far, no signs of any cracks within the ad market. It seems to only be getting stronger from here, and we'll see what comes out of the conference next week.
So there's a conference next week, we also have, listen, we got the Olympics on deck, we have the election on deck. How big a driver are those? How much are those tailwinds for the online ad market as well?
They should both be big tailwinds. Political is expected to be a significant boost this year. You mentioned CTV and streaming. That in particular is expected to be an area that sees a big boost from political spending, and Olympics as well. It's likely less of a boost, but it's certainly one that gets a lot of focus and attention. and there are some deals around streaming with Paramount and NBC as well. And so we expect a lot of focus on both of those things next week as well.
Yigal, you cover a lot of the companies that sort of help do programmatic ad buying online, et cetera. And of course, there's been a big shift in how we search for things because of the AI summaries at the top of Google search results, at least right now. How's that going to affect those companies, and what do you think we'll hear from folks at the conference about that?
Oh, well, that's an area where there's a lot of questions and uncertainty, but so far we really haven't seen any major shifts. And I know it's still really early, and things can certainly change. So, what we're starting to see is the AI companies license deals for content, right? That content is the data feed into the AI engines and LLMs is incredibly important, and so we're starting to see more and more licensing deals for those AI LLMs to feed off of, right? And so the debate right now is whether the publishers are trading off near-term fees essentially for traffic over time, and if people are going to spend more time within the search engine and those AI-generated answers versus shooting over back to those publisher websites and spending time there, right? And so this debate between spending time in search and spending time across the open internet, I think that's going to take some time to play out. But so far, we're seeing evidence that generative AI search results are actually pushing people back to the publisher websites, and it's feeding the ecosystem the way that it always has historically.
Yeah, besides Gen AI, I'm just curious, when you're talking to marketers and advertisers, what else sort of, what excites them, Yigal? Is it mobile display? Is it, is it video? Is it live audio? What do you hear?
Yeah, there's a lot of things that are exciting right now. We've talked about CTV, so that shift from linear to streaming TV, that's one of the biggest, most important topics that we hear about and likely get a lot of focus as well. And then, retail media, which is advertising on a retailer's website, or you think Amazon and sponsored listings, and that's happening across multiple retailers right now. That's a big area of growth. So AI certainly will be a lot of focus, CTV, and then the shift away from third-party cookies and privacy, where first-party data is coming in to take a bigger picture. That also feeds into this retail media story. Advertising on a retailer website, attracting buyers kind of at that bottom of the funnel on their shopper journey, where they're actually ready to make a purchase. Those are areas that are getting a lot of attention as well. So new ways of being performance-related advertising. There's a lot of evolution within that. We think we'll get a lot of focus in those areas.
And Yigal, just quickly, what are some of your top picks in this space?
And so within my coverage, the stocks that really fit in well to these themes are the Trade Desk. They are the largest demand side platform, independent demand side platform, play a really significant role again in those pipes on CTV and within retail media and other areas as well. But CTV has been their kind of core bread and butter growth engine. So that's really one that's at the top of the list. And then Criteo has been kind of reinventing itself around retail media. They've made a lot of progress there, and they've become a really important ad tech player within retail media. And they've been doing really well in their transformation journey as well.
Yigal, good to see you, and bon voyage. Look forward to hearing about all of the takeaways from that conference. Appreciate it.
Absolutely.
Well, Yahoo Finance is going to be on the ground there at Cannes, bringing you coverage all next week. We've got some big interviews lined up, including conversations with executives at Mattel and Pinterest. Stay tuned. Coming up next, we've got Closing Bell and Market Domination Overtime. There's the closing bell on Wall Street. Now it is market domination overtime. We are joined by Jared Blickery to get you up to speed on the action from today's session. Let's start where the major averages ended the day. The Dow staying pretty steadily in the red throughout the session, down about 120 points or a third of 1%. However, we have new records. Guess what? For the S&P and the Nasdaq. The S&P up about 0.25% by day's end. Remember, of course, we are going into tomorrow morning's CPI report, the Consumer Price Index, and then the Federal Reserve going to be holding its press conference in the afternoon. Not expecting any change to rates, but we'll get a new dot plot and, of course, any commentary that Jay Powell has on inflation and on rates. So that could certainly push things around. The Nasdaq finishing the day higher and also at a record up by 0.9%. Jared, another day where we sort of had a little bit of a drift higher.
Yes, we did. I think a lot of this has to do with Apple, which was just putting on a clinic today. This is how a breakout is made. And if we can go to the Wi-Fi Interactive, I'll show you briefly what I mean by that. We'll also check out the sector action today. In fact, let's start with the sector action. You will notice only tech, XLK, is outperforming the actual S&P 500. Communication services also in the green, but this is a tech story. And guess what? Apple front and center in that. Haven't seen a dark green square for Apple. Means it's really outperforming there, up over 3% in some time. And I'm going to be doing a deeper dive later in about 30 minutes later on in the show. But I did find when you have a breakout like this, and I've measured basically 15 of them over the last 20 years, you tend to get average returns of 30% over the next year with a green positivity rate of about 90%. So stay tuned for that. Also tracking financials. That is a worse sector of the day. Utilities and industrials not doing so well. We can take a look inside the tech sector at unprofitable tech just to show you how the bifurcation is going. We have kind of a balanced board here between green and red, but you take a look at software. Here you go. See a little bit of red there. Here are the semiconductors. More red here. Just really haven't seen the tech sector structured like this in some time. So we'll measure the entire ramifications of all this in about 30 minutes. Now, I should also point out that Bitcoin is flagging today. That's my #1 leader to the downside. And just taking a quick look at Bitcoin where we are, we can see we are having the worst day in a few weeks there, but as I like to point out, we are still in the upper end of its trading range and just consolidating. Doesn't mean much until it breaks to the upside or to the downside here. Josh.
Jared, thank you. Appreciate it. Stocks have managed to make headway amid market uncertainty on the U.S. economy. The Fed, of course, kicking off its two-day policy meeting as investor skepticism spreads over the path of rate cuts. Joining us now is Manulife Investment Management Senior Portfolio Manager Nathan Tuff. Nathan, good to see you on set.
Great to be here.
So listen, all eyes on that Fed meeting. I think the expectation is Jay Powell keeps borrowing costs where they are. But as Julie was saying, you're going to have that focus on rate projections, on Jay Powell's commentary. What are you listening for?
Yeah, the dot plot is the important news, I think. But the reality is, if you're going to make a shift in the dot plot, you're going to have to make a shift in some of your assumptions that go in to feed that dot plot, right? And so in order to lower the number of projections for quarter point cuts this year from, let's say, 3 to maybe 1.5 or 2, and I think it's probably going to be a 1.5. I think you're going to have a number of Fed members that say 1 still this year, and you're going to have a number that say 2. And so the average might be 1.5, which is certainly lower than the last Fed dot plot. But in order to get that, you're going to have an environment where they're going to suggest either growth is going to be a bit higher or inflation is going to be a bit higher, or both, in order to make that assumption. Because if they change nothing, then you got to question, why did they change the Fed dot plot if they didn't change their assumptions on growth or inflation?
Well, the market's already there, right?
Yep.
So is it sort of an acknowledgement of reality? But I guess they can't really do that without changing something.
You're right. They have to change something. And I agree with you. I think this could be a fairly boring meeting because
come on.
Now, I love a good surprise. So I do hope something.
Boring is in the eyes of the beholder, Nate.
That is true. We're always going to have something to talk about, right? But the reality is, I do think consensus probably has it fairly right for the time being. Where we're a bit different from consensus is we actually think there's a possibility that you could see more price quarter point cuts over the course of the next let's say, 18 months than the current pricing suggests. Because we actually think, given the Fed is roughly 250 basis points below their neutral rate, above their neutral rate, they actually have a lot of flexibility to do quite a few cuts before they actually become restrictive. So we actually think the market is actually underpricing the cutting potential over the course of the next 18 months. Timing is somewhat irrelevant, but it's really that magnitude over that longer period of time that matters more to us.
And so given that kind of backdrop, Nate, you look across the stock market right now, what looks attractive? Where do you want to be invested?
We are still overweight equity, and people are asking, why are you overweight equity when you have a Fed policy that's arguably restrictive and you have slowing economic data? And I do believe economic data is slowing on the margin. The positive, though, is I don't think the economic data is disastrous. And in many ways, counterintuitively, because that weaker data will afford the cutting cycle to begin, like other major global central banks have already done, that's a positive for equity. On top of the underlying fundamentals of equity still remain quite favorable. We are seeing positive earnings revisions, not only in the US, but outside the US. We're seeing quality of earnings still be very good. So I think it's premature to get too negative on equity risk, and therefore we're staying weight over equity, but we're also sticking with the winners within equity. And so I don't think you can be underweight tech yet. I don't think you can be underweight the large caps in the US yet. There will be a time when that makes sense. I just think it's a little premature at this stage to do so.
I want to dig more into strategy, but I want to linger for just a moment, not necessarily in the Fed, but on the other event tomorrow that might be more exciting, and that's CPI, right? Are we going to get, do you think, more confirmation that inflation is slowing down?
The general trend in our view is that inflation data is continuing to slow. Yes, over the last several months, we've had a bit more of a hodgepodge kind of back and forth debate on is slowing too slow, blah, blah, blah. But I think if you look at the overall trend, inflation is coming down. And I fully expect tomorrow you'll get a number roughly in line with expectations. But let's be honest, a 0.1 above or below is going to be market moving. And that's the reality of just how sensitive the market is right now to just modest differences in inflation, despite looking at the big picture that inflation is still trending down.
What about overseas, Nate? Any opportunity specifically?
I think there's more opportunity overseas than people give it credit for. And the reality is, if you take out the dollar dynamics, there's a lot of stock exchanges outside the US have actually posted decent local returns this year. We all think about it from a US dollar-based perspective in the US because that's how we invest. But if you're overseas, you've actually gotten some decent returns in parts of Europe and Japan, even recently in parts of Asia. And so there is some decent performance happening.
Do you want exposure to China?
I think you should be starting that. Now, here's part of the argument. We believe one of our big themes this year is that you should no longer assume that global economies are completely synchronized. They are not. You can point to COVID, you can point whatever argument you make, but the reality is we shouldn't assume when one economy is slowing in the world, everyone else is. So as the US begins to slow, we actually start seeing early evidence that China, at least directionally, is doing more combination, and there's a likelihood that growth will pick up. And I was just in Asia several times over the last few months. I can tell you from March to May, my 2 visits, the sentiment levels within Asia are improving. So the appetite to take risk is also starting to show up. And that's an important sentiment shift in my view, because local buyers matter a lot to some of those exchanges within the Asia region.
And yet, investors from here who have gotten in there have done so at their peril.
Correct. Yeah.
Who have over-anticipated that a recovery there.
This could be another head fake, and that's the risk, right? There is a legitimate risk because every other attempt over the last several years to say, oh, now is the time to buy emerging markets or now is the time to buy China has failed, right? And there is a risk that will happen. But I think what's different this time is you are seeing pretty consecutive pushes in the right direction by the Chinese government and policies to be more accommodative. It's not a bazooka, but directionally they're doing the right things.
Baby steps.
Baby steps.
Thanks for coming in, Nate. Good
Thanks
to
for
talk
having
to
me.
you. Appreciate it. We got to get to Oracle earnings. They are just coming out in the past few moments, and we're looking at a miss here for these numbers. So if you look at the shares, they're actually moving higher, interestingly enough. I think, if I had to guess, that has to do with a partnership that the company also
It's a little-known company.
So let's talk about that first, okay? Oracle and Google Cloud are announcing a partnership. It also is involving OpenAI, which will be using Oracle Cloud infrastructure to extend the Microsoft Azure platform. So it looks like there are multi-prongs and what they're calling multi-clouds as part of that. So that's on the one side. Then the company is also saying its fourth quarter revenue missed estimates. $14.29 billion, $14.57 billion is what the analysts had been anticipating. Earnings per share also missing estimates by 2 cents a share. The company is declaring its quarterly cash dividend of 40 cents a share. And then there is another area of beat that we should mention. That's in cloud infrastructure revenue, which is coming in at $2 billion, a little bit ahead of estimates.
Yeah, fiscal Q4 is typically a seasonally strong one for Oracle. Heading into the print, I know some chatter, some analysts were kind of worried just because of some of what they had seen from other enterprise software makers like Salesforce and Workday. But on this news here, Larry Ellison is out with a statement saying our multi-cloud cooperation with Microsoft expanded, he says, significantly in Q4 as we agreed to work together to support OpenAI and ChatGPT. He goes on to say, as this becomes available, it's going to, in his words, turbocharge our cloud database growth. Clearly, investors, at least initially, are reacting strongly. The stock was already up about 20% year to date heading into this print, tacking on about 8% initially after hours.
Yeah, and analysts who we've spoken to, some of them have said that this is sort of one of those names that, while it's not in the big headlines for the hyperscalers, it's one of the companies that is indeed poised to benefit from some of these various generative AI announcements. And I should mention the stuff I said at the beginning about Oracle's partnerships now with Microsoft and OpenAI on the one hand, and then with Google on the other hand. Those are separate announcements. So it had earnings, and then it came out with separate releases talking about these other partnerships. So again, one of those is that Oracle, Microsoft, and OpenAI are going to partner to extend the Azure AI platform to Oracle Cloud infrastructure. That'll give OpenAI more capacity, according to this release. And then Oracle and Google Cloud infrastructure are also going to have a partnership. So it seems like all of this is sort of aimed at supercharging these AI capabilities, if in my very layman's terms of what all of this means, but it also means upside for the stock.
Yeah, CEO Safra Katz saying in Q3 and Q4, Oracle signed the largest sales contracts in our history, driven, she says, by enormous demand for training AI large language models in the Oracle Cloud. She says in Q4 alone, Oracle signed over 30 AI sales contracts totaling more than $12.5 billion, she says, including one with OpenAI to train ChatGPT in the Oracle Cloud. Investors seem plenty excited so far in the after hours.
Yes, they do. And the stock, by the way, it's not quite at a record, but it actually is kind of close to a record. It was at a record back in March. That record was 129.24. So we'll see if it's trading above that right now.
All right, well, you know what, Julie, still to come. We're going to talk so much more about this. We're going to break down these Oracle earnings a little more with a strategist as shares are soaring here after hours. Stay tuned. More market domination over time. That is coming up.
Oracle just reporting fourth quarter earnings, as well as two separate AI partnerships moments ago. The stock seems to be rising on those announcements with Google and with Microsoft and OpenAI. Joining us now, Dan Morgan, Senior Portfolio Manager at Synovus Trust. So we got a twofer, or maybe even a threefer, I guess, Dan, with the earnings and then these partnership announcements. What's your big takeaway here? What do you think is the most important thing that investors should be looking at from this news?
Well, Julie, it's kind of a mixed report because, as you mentioned in the beginning, they missed on earnings, they missed on revenue. The all-important number, which is cloud services revenue, which, as you mentioned, they missed slightly. And we also saw the overall growth rate fall to about 20% compared to 25% in the third quarter. But then they beat on their OCI number, their infrastructure cloud business, as you mentioned, was a little bit better than expected, around $2 billion. So it seems to me, guys, like the street is kind of pushing that aside, and they're really just excited about these partnerships and anything that Oracle can do to, move forward their cloud business. They're going to get excited about. I mean, they generate about 38% of their revenues right now from cloud, and Oracle's got a great opportunity. If they can cross-sell their huge mega database population, which is about 400,000 installs, into their cloud business, it'd be huge. So I think that's what everybody's excited about with these partnerships.
Yeah, and Dan, they're just talking to the execs, giving a little commentary, saying throughout fiscal 2025, they talk about continued strong AI demand to push Oracle sales and RPO even higher, result in double-digit revenue growth this fiscal year. Dan, for investors listening right now, they're always looking for smart AI plays. Do you consider Larry Ellison's company to be one of them, Dan?
We do. I mean, I look at Oracle as a dominant player in database. They have about 42% market share. They've been around forever, Josh. I've been following Oracle for over 30 years, and they've got into all the other hot businesses in the past, and then they got into cloud. And, they do have a bit of a distinct advantage over, let's say, an Alphabet or a Google with GCP. They're not quite as large, obviously, as AWS with Amazon and Azure with Microsoft. But they're gaining share. I mean, they're still a single-digit market share, but they're high, single digits, and they're moving up. If they can continue to, like I say, take advantage of this great opportunity they have with this huge installation base, and I think that's what the street sees. And we also see, Josh, consistency. Oracle is very consistent because of their customer base is heavily governmental. They have very reoccurring, about 70% of their revenues are reoccurring. So it's not as risky as, let's say, a high-flying software company that's hoping to close that deal by the end of the quarter so they can beat numbers.
Dan, what is the role that Oracle is playing? When we hear about these new partnerships with OpenAI for its infrastructure, what exactly, where does it fit in?
Well, that's a good question, Julie. Unfortunately, I don't have a perfect answer, but I would expect, because those are the leadership companies, I mentioned Microsoft, Azure, and they're really gaining market share right now in AWS. The fact that they're able to put together these partnerships and be able to work together opposed to working against each other is huge. So I think that's why the street was reacting so positively to this announcement. I think, Josh and Julie, if we were to not have those announcements that they made with those partnerships with GCP and with Azure, I think you might have gotten a little bit of a different reaction on this stock with this earnings report because of that miss that they had in cloud services.
Dan, I want to switch gears here a bit. Stick with the AI theme, Dan, but interested, listen, Tim Cook took the stage yesterday and he kind of laid out his AI vision, his AI strategy, and investors, Dan, they were plenty excited about that today. That stock soared. What did you think, Dan? Were you as excited?
Well, it's interesting, Josh, because, everybody was really negative on Apple compared to the other mega techs in terms of their AI strategy. And we talked about that before in the show. Everybody was unveiling this great, upcoming roadmap, Meta, Alphabet, and really Apple was kind of being left behind. And so we're waiting for this developer conference for Tim Cook and company to come out and make their announcement. And there wasn't really too many big changes, Josh and Julie. I mean, instead of hitting like a grand slam home run, like NVIDIA with a Blackwell chip or, Microsoft buying ChatGPT, they're going to do it a little bit at a time with their current product mix. And they outlined that roadmap at the meeting. So I think it's a positive. It gets a new frame of thought surrounding Apple stock in terms of their AI initiatives. And it's not the old rerun that we've heard that Apple's missing out, everybody's passing them up in AI. They definitely have a strategy. and they laid that out, and I think it was a positive.
The stock closed today at a record, Dan, as people kind of took a second look at it. Would you add to an Apple position right now?
You know, Julie, we have massive position in Apple. We started buying it back in 2005 at a cost basis of like $1.23 with all the split adjusted
Must
time.
Be nice, Dan.
Yeah, I mean, I added it to the buy list, and I'm from the Bay Area, and I was out in California, and I was seeing things really taking off at that time with their MP3 player. This was for the iPhone, and we put it on the list. So, you know, it is a stock that just about everybody holds, and everybody has these huge concentrations in it because it's done so well. So, you know, for, you know, obviously investors that have the right risk tolerance, right objectives, it was something that we'd look at. There's no doubt, Josh and Julie, the stock is very extended right now based on a multiple basis. If you're to look at, let's say, the growth that we're expecting out of it, which is kind of single digit, trades at a pretty high multiple. But, you know, it's been on our list for a super long time. It's been a tremendously successful stock for us. And, you know, it's just been a big winner, so it's hard to turn your back to it. So it's definitely something that is on the list, and we would continue to look at to purchase for the right investor with the right objective and risk tolerance.
And last question on Apple, Dan. You have been, you know, a long time shareholder there. Did you think what Tim Cook announced yesterday? You know, I think one big question investors are trying to figure out whether that kind of jumpstarts some meaningful iPhone upgrade cycle. Any thoughts there, Dan?
That's a great question, Josh, because, you know, they're going to come out in September with iPhone 16. They have the new iOS 18 operating system, which is laden with AI features. They also have the new revamp they're doing on the Siri. They have the Gemini relationship with Alphabet. So is that enough to kind of gel that super cycle upgrade tick that we haven't really seen, right, guys, in the last couple new releases? So I think it could. I think we could make a strong case that, you know, with enough built-in AI features, people would want to go and go get that new iPhone 16 and opposed to just kind of waiting around like they have in the past with iPhone 14 and iPhone 15.
Dan, always great to have you. Thanks for joining us.
Thank you.
Time now for What to Watch, Wednesday, June 12th. Starting off with the Fed, the FOMC began its June meeting today. Its decision is coming in the afternoon. While no rate cut is expected, we will be getting an updated dot plot. Fed Chair Jerome Powell will hold a news conference at 2:30 p.m. Eastern. Yahoo Finance coverage will begin just before that at 2 p.m. Eastern tomorrow.
And just hours ahead of the Fed decision, we'll be getting the latest look at inflation. The CPI print for May, that's the Consumer Price Index, will be coming out at 8:30 a.m. Eastern. Economists forecasting core CPI will hold steady at 0.3%, while overall CPI could drop to 0.1%.
And on the earnings front, we're going to get reporting from Broadcom, Dave & Buster's, and Aurora Cannabis. Broadcom announcing second quarter results after the close. Analysts expecting an inline second quarter from the chip maker on the back of AI, but for weakness in its non-AI segments to offset some of those gains.
And that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we are watching. Don't call it a comeback. Apple shares surging to a fresh record high on the second day of its developer conference. The pop comes one day after Apple's AI strategy was met with lackluster stock reaction. Investors rethinking that today. Plus, stalling out tax credits and price cuts have not been enough to drive EV demand as much as some car makers were expecting. General Motors trimming its full-year production forecast for EVs. That's just months after Ford announced it was delaying production of 2 EVs in its lineup. And it's a battle for business support on the 2024 campaign trail. Dueling events today were attended by Biden officials and Trump as each side aims to argue its administration is the best-case scenario for Wall Street. And the S&P 500 and Nasdaq closing at a new high as Apple surges to a record. Here with more on the trading day takeaways, let's get right to Yahoo Finance's Jared Blickery. Jared.
Thank you, Josh. Guess what? I'm going to call this a comeback because Apple has been going nowhere for years. You can see it's up 7% today, best day in several years. This is what it looks like today. I'm going to show you the last 2 years, and you're going to see what I mean by this breakout. We were just going nowhere for quite a long time here, and this is only recently. We can see over the last 5 years, which includes all the pandemic. In fact, there's been a lot of sideways action here. So we got to new nominal highs, but now we're finally breaking out. What's interesting about this, and by the way, let me just show you our takeaways board. Nicely prepared for us. This is Apple breaking out to a new all-time high. But I did a study, and so I took a signal day like today. So if you have Apple gaining 3% and breaking to a new high, I've calculated this happened 15 times over the last 20 years, and we're only allowing one signal per quarter. What's important is what happens afterwards. So one day later, up 0.4%, only 4 times out of 10 is a positive, but you start looking at 1 week, 1 month, quarter, year later, all the way up to 88%. These are really good statistics, even for a stock that is mostly going up, because there are long periods of time where it has this breakout and it finally goes to the upside. What's the risk here for this? Because we're looking at average gains of about 30% over the next year. This is the VIX. Going to look at that in a second here. But what I want to show you is that Apple chart once again. So we're looking at 5 years here. What's the risk is that this is a false breakout and we head right back down over the coming days, and then we head down some more. But that's the high risk scenario, but it is low probability. That's not what I think will happen.
And so for the market, Jared, sort of bigger takeaways when a name like Apple starts working again like this?
Yeah, so for the longest time, we've been talking about this NVIDIA story, which is the AI story. Apple has kind of been left out, and you can see this on the year-to-date totals. Apple was basically break even to start the day for the entire year. And NVIDIA up 144%. NVIDIA has been getting all the action. NVIDIA might be a little tired here, so it would be only fitting if another big stock could carry the AI banner for a while. Apple, perennially a leader for the stock market overall over the last 10 years, so it's probably comfortable for a lot of people just to see it leading again. I take this as a big positive for the market.
All right. Jared Blickery, point number 2.
Yes, we are looking at complacency in the market. So let me advance here. We got Apple breaking out to an all-time high, but stock volume plummeting recently. Let me give you some statistics. So I look at SPY volume. SPY is the S&P 500 Spider ETF that is kind of a proxy for the market overall. I have been seeing the lowest volume in SPY recently in years. And sometimes what happens in the summer is, all right, May, June roll around, you see volume kind of flag a little bit, but this is extreme. I don't want to say extreme, but I want to say more than average. So we're seeing less volume than average. What this reminds me of is that a few summers ago in 2022, when we had that big bear market, everybody was kind of scared. We did see stocks for a little bit, they managed to rise. And so there was kind of this feeling in the market that everything is okay. But I think, that old saying, sell in May and go away, should be changed to hedge in May and go away. And I think that's simply what we're seeing here. Finally, I just found my chart. Here's 2022. Here's that summer rally that I was looking at. And I think simply market participants are just really not that active this summer. I think they put their positions on, their hedges, and they've kind of walked away for a little bit.
Minimize me. All right, third one, Jerry.
All right, we'll get to this real quickly. This has to do with Bitcoin and Ether just having their worst day in 5 weeks. So I'm going to go to the charts real quick. I showed the Bitcoin board, the Ether board, at the close today, and you can see once I load them here, just give me 2 seconds, and there we go. You can see a lot of dark red on the screen. Here's Bitcoin. What I've been pointing out year to date is that we are in a trading range. So this might be the worst day that we've had in a few weeks, maybe in about a month or so, but until we break out of this range to the upside, to the downside, this doesn't mean a whole lot. And you take a look at Ether, it's a pretty similar chart. There you go, just a little bit bigger trading range.
Very quickly, does this tell me something about risk appetite heading into the Fed meeting?
Good question. Bitcoin has been correlated over the last few years, with risk appetite heading into the meeting. I don't know, because you look at copper, that was kind of a risk appetite thing that made a new high, then it sunk to a new low. You put that in conjunction, the commodities market with crypto market, maybe risk is a little bit tired right now. And you kind of put that with my prior thesis that the market might be on autopilot through the end of the summer. And this kind of plays into it. So I'm not expecting a huge shakeup tomorrow at the Fed meeting, but maybe things skew a little bit more risky than bubbly.
Yeah. All right. We'll wait and see. Jared, thank you, my friend. Appreciate it. Biden administration's electric vehicle push is hitting some speed bumps. New survey shows Americans are hesitant to go all in on electric. In a recent survey, only 21% of adults said they were very or extremely likely to buy an EV for their next vehicle, with charging time, availability, and vehicle range among top concerns for would-be buyers. Joining me now, Houman Shahidi, co-founder and CEO of charging infrastructure company EV Passport. Houman, it's good to see you. Maybe just start, Houman, listen, you're an EV hardware, software company, but for viewers who may not be as familiar, Houman, just explain a little bit about the company, its mission. What's the problem you're trying to solve for? What's demand been like?
You bet. Thanks for having me. So EV Passport, we're an electric vehicle charging platform that focuses on infrastructure as a service. So we're a turnkey solution that handles the end-to-end value proposition for asset holders across the board. And the diversity of our customers has never been greater. We operate in Canada and Mexico, but also across 35 states and have most recently in last year raised $200 million to support that growth.
And Houman, when you look at your market, what do you think kind of growth looks like, over the next 1, 3, 5 years? How do you model it?
The opportunity is incredibly vast, and we could not be more exhilarated by what's ahead of us. In fact, the recent news with Tesla is obviously sad when people lose their jobs, but it ignites the opportunity for us. And we fundamentally don't believe in competitive landscapes. We believe that there's an opportunity for us to go chase that wallet share, and it's an opportunity for us to talk about our platform, which is really focused around the software customer-centric approach, leveraging an open API, and also carrying out the mission of what the Biden administration has done, because this critical infrastructure is super important to the infrastructure of tomorrow.
And Houman, I do want to get your kind of just broader pulse check on the EV market. We referenced that at the top here. It is growing, Houman, but it's not growing as fast as it once did. Why do you think that is, Houman? And what do you think jumpstarts that?
I actually do think it's growing fast. Ford just recently last week announced that 65% of the new cars sold were either plug-in hybrid or electric vehicles. So I think the trend is bullish. Sometimes the headlines are funny because people see the output. Infrastructure is a lot like an iceberg. It takes a long while for it to move and get to where it needs to go. But at the end of the day, people realize the economic value, and also the programs set by the administration have done a great job to be a tailwind in getting us to go there. And it has allowed for investments in this space to really take flight.
And Houman, we do have an election coming up. It sounds like you're pretty happy with this administration. If there was a change in administration, Houman, if there was a change in the White House, how would that affect your business?
Well, we've built a business that's focused on reliability, security, and a pathway to profitability, right? The number one stakeholder for us is our customers. And at the end of the day, it's critical for us to maintain customer success. It's the lifeblood of how we're going to grow and grow. But either way, we think the tailwinds supported by the administration are helpful for business and allow for EV adoption to accelerate, more than a potential change in 1600 Pennsylvania.
Get you out of here on this, Human. I am curious, as you kind of build out this infrastructure, can you find enough workers, Human? Can you find enough electricians right now to do the job?
That is a consistent challenge, but it's also an opportunity, right? I mean, now more than ever, there's, investments going towards trades and other areas where we're going to build the master electricians of tomorrow, and they're going to make good money too as well. So the labor market is ripe for opportunity in that regard, and we have amazing partners. We have over 200 certified EV passport partners within our network, and a lot of them are leveraging new programs with trade schools to be able to support the ongoing demand.
Human, thank you so much for joining the show today. Super interesting conversation. We're going to keep having it. Thank you.
All right, thanks for having me.
And coming up, which administration has been better for the economy, Biden or Trump? We're taking a look at the numbers in our latest edition of Bidenomics. We're asking for a trend on the other side. As part of the Bidenomics report card, Yahoo Finance is comparing the performance of the Biden economy with the Trump economy at the same point in their presidencies. Rick Newman joins us now for more. Rick.
Hey, guys. There's this famous question in politics when somebody's running for re-election. The challenger might often ask, are you better off 4 years ago than you are today? Ronald Reagan used that formulation for the first time in 1980. He won, of course, because a lot of people said no. Inflation back in 1980 when people voted was almost 13%. And people said, no, I'm not better off than when Jimmy Carter came into office. So you might hear this time around, except I think Donald Trump is not going to be asking this question because he doesn't want people to remember the way the economy was 4 years ago. And just to remind everybody, 4 years ago, we were smack in the middle of the COVID pandemic. Lockdowns were happening everywhere. And if you just put this up on these charts I've been keeping, comparing the Biden economy with the Trump economy, there you're seeing, that's a weird one, income. We'll talk about that later. But GDP growth was falling off a cliff at this time in 2020. Employment, we lost 22 million jobs in just 2 months in the year 2020. And we had a really short, but a really deep recession. It only lasted 2 months, but a huge wipeout in employment. So, during the rest of the Trump presidency, his last year in 2020, the economy did begin a slow recovery, helped in large measure by all that fiscal stimulus and a lot of monetary stimulus by the Federal Reserve, but it just took a long time. So the economy in the last year of the Trump presidency was pretty bad. And I think you could even argue that some of the things that were happening then laid the groundwork for the inflation that surged in President Biden's second and third year.
Don't you think, though, Rick, a lot of Americans might sort of give Trump a pass in some sense, just happen to preside over this once-in-a-century pandemic?
Yes, I think the data actually shows some voters do give Trump a pass, but I think you're also going to start hearing President Biden trying to flip that story around and telling about, he's already out on the trail saying it, trying to associate Trump with the COVID pandemic, with the chaotic handling of the COVID pandemic, and with a lot of the economic problems that happened during that time. So it does seem that, some people call this Trump amnesia or Trumpnesia, that some voters seem to remember what was good about the Trump economy, and they don't remember what was bad about it during the last year. So if you're somebody who thinks of the Trump economy as the pre-COVID economy, that was pretty good. We didn't have any inflation to speak of. Gas prices were pretty low. We didn't have runaway growth either, but the economy was doing pretty well on a steady state basis. But I can guarantee you during the next 4 months, President Biden and his campaign are going to be doing everything they can to change that narrative, to change what voters remember about the Trump economy and get them to focus on the COVID recession.
All right. Thank you, Rick. Appreciate the time.
Yep.
President Biden speaking today at a gun violence prevention conference in Washington, highlighting his administration's work to address the issue.
It builds upon the dozen of executive actions my administration has taken to reduce gun violence, more than any of my predecessors, and I suspect more than all of them combined. Everything from cracking down on ghost guns, gun trafficking, so much more. Folks, we're not stopping there. It's time once again to do what I did when I was a senator. Ban assault weapons.
Biden speaking as new data suggests Americans aren't buying as many guns. There were 1.09 million gun-related background checks in May. That's down 7% from a year ago, according to the National Shooting Sports Foundation. And that continues a downward trend that started in January. So what explains this trend, and where do gun sales head from here? For answers, we now turn to Stephen Gutowski, founder of The Reload, a publication focused on gun policy and politics. Stephen, it is great to see you. So you point out, Stephen, we did see this drop in monthly gun-related background checks. Stephen, let's start there. What explains, do you think, that trend, Stephen?
Well, I think it's actually a very unusual trend. It's kind of counterintuitive from what you might expect during this period as we're headed into the election, especially with President Biden making the sort of promises that he just did in that clip, where he wants to institute new gun restrictions, specifically on so-called assault weapons, which include things like the popular AR-15. And traditionally, that's led to people to want to go and buy those guns. And we're not really seeing that this time around. And there could be a number of reasons, right? 2020 was such an unprecedented record year in gun sales that we may still be experiencing a come down from that 4 years later. People may also not be as worried about new gun bans because of action by the Supreme Court in 2022 as well.
And touch on that, Stephen, for those who aren't familiar. When you say the Supreme Court may have given gun owners a bit more comfort in this country, how so?
Yeah, so in 2022, the Supreme Court handed down a decision that struck down New York's concealed carry law. But in addition to striking down that law, they also implemented a new standard for how they decide Second Amendment cases moving forward, one that's sets a pretty high bar for current gun control measures and puts a lot of these sorts of assault weapons bans or other hardware bans in question constitutionally. And so people may feel that that provides a greater level of protection than it used to. And you may not have that kind of rush to the gun stores that we're used to seeing in the wake of somebody running for president advocating for new gun bans like this.
Yeah, and just to stick with that, Stephen, so, we heard from Biden there. How are Biden and Trump sort of positioning themselves, campaigning around this issue? And how important do you think it is politically in this election?
Yeah, well, they're kind of mirror opposites of one another right now. I mean, Joe Biden, as you just showed a clip from there, spoke at the Everytown National Conference today, and former President Donald Trump has spoken at the NRA already twice this year with another event planned later this summer. They've basically taken exact opposite tacts on gun control policy as well. Trump has promised to undo many of the things that Biden just touted as accomplishments there in that clip. So, there's pretty much as polarizing the issue as you can get. Of course, there's also the ancillary things beyond their policy positions, right? Donald Trump was just convicted of felonies, which means he can't own guns, which is kind of a pretty weird place for somebody who's the pro-gun candidate to be. And then President Biden's son was just convicted on felony gun charges as well, right before he gave that gun control speech. So it's a pretty strange situation we're in.
Strange day, Stephen. Lots of moving parts. Here's the part of the chat, Steve. I ask you to take out your crystal ball. I'm just interested, Stephen, when you look ahead, do you see gun sales inflecting higher in the back half of the year?
Yeah, that's the hard question, because I would have expected them to already be rising right now as we're headed into this pretty tumultuous election. It may also be that people aren't paying as close attention to politics at the moment. You've seen that in news ratings, for instance, but maybe they'll come up again. But the industry is kind of still searching for that floor. It's a ebb and flow industry. It's a feast famine sort of business, the gun industry, and they haven't yet reached the floor from that 2020 surge. They're still just a bit above where things were before it. So maybe they'll hit it soon.
Very quickly here, Stephen, I just want to end here on one very interesting trend, how you've seen these gun makers, Stephen, actually kind of decamping, moving from blue to red states. Quickly, Stephen, why is that occurring, and what are some names? What are some examples?
Yeah, absolutely. A perfect example is one of the only publicly traded gun companies in the country, Smith & Wesson, just moved from New England in Springfield, Massachusetts to Tennessee. And this is comes directly from the politics surrounding guns in our country, where a lot of these major American manufacturers were founded in states that now have implemented stricter and stricter gun laws, and they've become disfavored businesses in those areas. And so they're searching out more favorable conditions, often down south in red states.
Stephen, such an interesting trend and a really important one to a lot of Americans. Thank you so much for joining the show today. Appreciate it.
Thank you.
And coming up, growth exchange-traded funds feeling the love from investors, but where does that leave value? More on this on Asking for a Trend. Value appears to be sitting in the shadows of growth, but how much has it been overlooked? Joining me here with the details is Yahoo Finance's very own Julie Hyman.
Very poetic there, sitting in the shadows of growth. This chart coming to us courtesy of Bank of America, which sort of looked at the value growth dichotomy in a recent note and pointed out that if you look at ETF flows here in the United States, that investors really have preferred growth over the past few years. So this is a chart of the flows into those types of funds. There's a $75 billion gap between the two. So since 2019, we have seen $173 billion go into growth-oriented ETFs, only $96 billion into value-oriented ETFs here. And Bank of America said that value is overlooked and under-owned. Now, just quickly, when we're talking about growth versus value, what are we even talking about? Growth, it's sort of inherent in the name, right? It tends to be the growthier sectors, the ones that see more revenue growth especially, but also profitability growth. Value tends to be some of the cyclical sectors. Energy and financials tend to fall into those categories that tend to be viewed as value or sort of lower PE names, so to speak, Josh.
So, Julian, why does Bank of America think value is due for a comeback here?
Well, part of it is reversion to the mean. Is that over the longer term, much longer term, value had tended to outperform growth over the longer term, really until the past decade or so when growth started gaining more consistent steam. The Bank of America folks are also looking at what they say are their forecasts for inflation, industrial production, and oil production, and that those various factors should be positive for these more value-oriented names. But of course, this is not consensus here. It's a little bit out of consensus. I mean, for example, we talked to Omar Aguilar of Schwab Asset Management at 3 p.m., and he said he doesn't even really like those value growth labels. He's preferring to look at what he calls high quality, that have consistent cash flow and growing dividends over time. So you have to wonder if the growth versus value sort of even just labeling them that way has sort of been falling out of fashion.
All right, Julie, get you out of here on this. It's you and me tomorrow. And all the investors, viewers, we're all focused on the Fed. What do you expect from Jay Powell when he's on the mic?
Well, listen, he's going to say probably what he has been saying, right? Continue to emphasize that we need more good data. Obviously, that's going to be very important in the context of what we're going to hear tomorrow morning with the consumer price index. Will consumer prices, the increase that we've been seeing, continue to moderate for some extent? A lot is riding on that. Then what is the dot plot going to say? What does the Fed expect in terms of how many interest rate cuts we're going to see this year? How much are they going to be pushing back the expectations for when they're going to begin rate cuts? So a lot will be on the table. It will be, Josh Lipton, anything but boring.
That is so true, Julie. Thank you very much. Appreciate it. And that is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great night.